going to talk about loan calculations. So whether you are looking to get a car loan, you want a mortgage, you even want to maybe finance furniture from maybe like rooms to go or any of these pay plan type scenarios, and you want to do an actual full amount of how much these loans are going to cost you, we are going to take a look at all of the information that you need to have to calculate a loan. So let's look at a car loan and the mortgage. These are amortized loans and with fixed payments. So an amortized loan with a fixed payment, what is that? Each payment covers the principal amount and the interest expense, which usually reduces the principal amount each month. So your principal amount is how much money you actually need to go and ask a lender. Now the interest rate, this is the amount of money that is going to be charged to you to borrow that money. And it's usually expressed as a percentage. When you go to, let's say, get a car or a mortgage, you want to look around to different places. Okay, the number of payments. So this is the total number of payments to be paid. And you have to just be aware of what your term for your loan period is going to be. We are also going to look at the total payment amount for that item. And the total payment amount is going to include the principal payment plus your interest charges. So you need to know at the end of the day, how much am I actually going to pay for this house? So I need to know how much the principal is and how much interest charges. We have an example for a mortgage. And a mortgage is simply a loan based on a residence, a home or a condo or such. So with this example, this is just something that's kind of typical. We have a 30-year mortgage with monthly payments. The interest rate is 3.0 and the principal amount is $150,000, and we want to know what is this monthly payment going to be. So once again, we've broken it down by looking at the loan terms. So that's going to be 30 years with monthly payments. The interest rate is 3.0% and the principal amount is $150,000. Now I did find this online calculator at bankrate.com and it was fairly simple to use. And so here's a website link, if not you can Google it. So here's the bankrate.com. This is your mortgage calculator. It is an amortization schedule. And let's go down here. We are actually going to fill in the information on the left hand side. So in our example, we had the mortgage rate is $150,000. We're going to put our mortgage in terms of years of 30 years, or you can calculate it by months. And in this example, we use a 3.0 interest rate, but you can use whatever calculation you want. And if you make any changes to the variables on the left hand side, make sure you hit calculate so you get your updated numbers. So when we do that, we see that our monthly payment is $632.41. Now looking at the rest of this information is our total principal paid is $150,000. But here is a key factor that we need to consider is that your total interest paid, that's just the amount that you're paying to your lender for the use of their money, is $77,666.18. So that is a big chunk of money. So that's almost you're paying $150,000 plus the $78,000 to buy this house. So what I'm going to do is scroll down here and kind of show you the importance of paying any money early. If you have any extra money sitting there, whether it's you're making it a small payment every month, you are maybe getting your tax refund and making one large payment every year, or making a payment every 2 weeks throughout the year, so that means you actually get an extra payment in for the year. However you want to think about doing that, this is how I'm going to show you some examples of playing with the numbers of how these small payments can make a big difference in how much interest you pay overall. So I'm going to hit the show amortization schedule. So when you close on your house, you're going to get this full schedule depending on your start date of the loan and things like that, and when you close on your house. But the main number here that we want to look at is your estimated payoff date is November 14th, 2051. Right? So I'll just run through this very quickly. We have your payment date, that's the first month. This is your total payment, which was at $632.41. Now, of this dollar amount, $257 is going towards principal, and then $375 is going towards interest. And this total interest, that adds up. So your first month you have $375, second month you have $374. So we're going to add those together, and at the end of month 2 you're paying almost $750. Right? So that's what this total interest column is. So that's going to get you back to that $77,666 if we scrolled it to the very bottom. Now your balance, though, that's the balance of the amount you owe on the loan. So it was $150,000. You make your first payment, it brings that $150,000 down to $149,742. So this will go all the way, decline every month, all the way down to 0. All right, so let's say we have the add extra payments. That's what I like about this calculator. So let's just say this is the house that you want. This works for your budget, but what happens if we add some extra payments? Now remember, right now, the main loan, it always is going to be paid off November 2051. But what happens if we just add, let's say, $25 a month to our mortgage, our monthly mortgage payment? We're going to hit $25 here, and then we're going to put apply extra payments. So then it reduces our payoff to February of 2051. And that's almost a year and a half early. But let's go up. So it reduces your interest payment. Your monthly payment's always going to stay the same because that's the amount of the loan. That's the minimum amount you have to pay. But it does pay off your interest or your loan early and less interest. So that's, instead of the $77,000, almost $78,000, you're paying around $72,500. All right, so let's say we don't really like that option. What we're going to do is every year, at the end of the year, it just has December, so maybe you get an annual bonus from your company. You're going to put an extra payment of $400. What does that do? Okay, that moves our payment date from November 2051 to July of 2049. So that's a couple of years early that you're paying off that loan. And now you can go back up here, your total interest paid, if you decide to do that option, is $70,655. So you're essentially saving $8,000 over time. So, and and a little bit may not sound like enough money right now, but over time, if you can just put some little money here and there towards that mortgage, it's going to reduce that money earlier. It's going to reduce your loan earlier. You can pay it off earlier, and then you're paying less money on your house, right, overall. And then your third option, you can do as a one-time mortgage payment. Just say you received an inheritance, you found some money that you didn't know you had in a long lost account or something like that. And let's just say you got $5,000. That has never happened to me, but we'll be optimistic here. But what does that do to our numbers here? That actually reduces your payment by just 1 year and a half. So that's May 14th, 2050. And that reduces it to $70,685 for your total interest paid. So the value of this is just seeing how much money you can pay early to reduce your total interest paid in the long haul. So once again, our example answers for the mortgage is our monthly payment is going to be $632.41. And remember, that's just for the loan. That's not insurance. That's not PMI. It's not HOA fees, and no real estate taxes, anything like that. This is just simply for the mortgage. So remember, though, that your total amount paid is $150,000 of your principal amount plus your interest charges. And the interest charges were $77,666.18. So that means your total payment for your house, you need to consider it's $227,666.18. All right, so that is the basic information that you need when you're looking at how to calculate a loan, whether it's a car loan, whether it's maybe a rent-to-own type loan situation, or a mortgage. If you have any questions, feel free to reach out to me at smartandsassymoney.com. Thank you.